Hey everyone, it's Griffin here, and I hope you're all having a great day as always. So in today's video, I wanted to speak about some of the main pros and cons of paying off the entirety of your house's mortgage early, and whether or not paying off a home early is something that's beneficial over, say, maintaining mortgage payments but investing at the same time. What really makes the most sense? By the way, I was somewhat inspired to make today's video after watching a video over on fellow YouTuber JJ Buckner's channel, where he's mentioned that recently he's managed to pay off the entirety of his home's mortgage. Mega props to you, that is awesome, JJ. But on my side, I wanted to share my 2 cents about this very topic as someone who does own a house now, as well as a couple rental properties. And we speak about real estate quite a bit on this channel. So this is something that I also get asked quite a bit, and I wanted to share my thoughts. We'll start the video off by covering both some financial as well as psychological factors to consider in this overall decision, and then following that, we'll also consider a comparison between keeping a mortgage investing at the same time versus just paying off your mortgage in its entirety at an accelerated pace. But right now, in this low interest rate environment, on paper, it usually doesn't make too much sense to pay off a home's mortgage in its entirety prematurely if you're strictly looking at this both from a financial as well as return on deployed capital standpoint. But there's more to consider in this overall equation, so let's just get right into it, starting with the financial things to consider. All right, so when you think about the financial benefits of having a fully paid off home, what comes to mind first is most likely how amazing it would be to be able to finally lower your overall living expenses so that you can go out and replace those mortgage payments with brand new payments on a Porsche. I'm just kidding, of course. But for most people, regardless of your age or where you're at in your career, if you do maintain mortgage payments right now on a property, this is probably one of the larger month-to-month payments that you have to make. So eliminating this can drastically impact your cost of living. In fact, right now in Canada, the average home price is roughly $680,000, even though this has increased significantly over the past year or so. So with a traditional, say, 20% down payment and the current interest rates of, let's say, right around 2.2% if you do have good credit, well, you're looking at monthly payments in the waters of around $2,440 a month, which is definitely one of the larger monthly payments that most people would have to make. If you do have larger monthly payments for anything other than your home that exceeds $2,500 a month, you should probably be reconsidering what you're spending your money on. So lowered overall living expenses, that's definitely the first main advantage of having a fully paid off home, and arguably the most important. That's why we covered it first. Furthermore, if you're someone who's looking to achieve earlier retirement than that typical 65 years of age, then eliminating your largest monthly expense is definitely that first ticket to achieving this goal. The overall idea here is that if you're able to eliminate the entirety of your mortgage in, say, your mid-30s, well, most likely you've also been investing a little bit on the side, maybe acquiring some rental properties, purchasing some stocks, exchange traded funds, etc. And so you don't need to eliminate the entirety of the mortgages on your rental properties. That would make no fiscal sense, actually, when you look at how a rental property generates income. But my point being with this is that you most likely also have another form of investment portfolio that's generating recurring cash flow for you on a month-to-month basis. So first, eliminating that largest monthly liability, which is the payments on your primary home, and then also having cash flows to supplement the rest of your living expenses is one of those first ways that you can retire at an earlier rate than in your 60s. In parallel to what we just spoke about, well, one of the other main advantages of eliminating that large payment is an increased saving and investment rate that you're able to accomplish on your disposable income each month that you can put towards other investments, be it paper assets or even, let's say, physical real estate through rental properties. The reason for this is that, psychologically speaking, for a lot of people, after paying off all of their living expenses on a monthly basis, including that hefty mortgage payment, well, it can be difficult to put some money aside for your savings goals as well as your other investments. So again, eliminating that large payment is a surefire way to increase your savings rate on a monthly basis. Moving on, the next main advantage of fully paying off your home is the direct impact that this has both financially but also psychologically on your net worth, which is simply the difference between your total assets minus all of your liabilities. So if your house is worth $500,000 in the market right now, you have $300,000 worth of equity built into the property from years of paying off the loan, and therefore you still have, say, $200,000 in mortgage loan out on your primary residence. Well, simply put, this would contribute contribute $300,000 towards your net worth, of course, excluding the cost of selling the property. Considering this, there are two main things that are impacting the equity on your home, and therefore how this is contributing to your overall net worth, being building up that equity over time from paying down your mortgage loan on a month-to-month basis, and then also, of course, that natural appreciation in the value of your home over time. From this chart right here, we can see that the net worth of Canadians has actually drastically increased over the past year as a result of the equity in their home increasing. So whether or not you have a paid off home or not, this is something that any homeowner would benefit from, which is an increased natural appreciation of home prices across the country. Now, of course, this type of rate may not sustain over the coming years. In fact, it most likely will not, seeing 30% increases in a year. But regardless, having a home is something that will significantly contribute to your net worth. In addition to this, on average, Canadian homeowners have quite a bit of equity built into their property, as well as that appreciation that they've incurred through holding the property over time. On average, Canadians have around 73% of their home's value as equity over a balance on their mortgage payments. I often tell people that paying down your mortgage is one of the easiest ways that you can increase your net worth, because your home is like a forced savings account. Every month when you're making those payments, remember, a portion of this is equity that's being built up in your home, and that is tax-free equity that belongs to you when you go to sell the house later on down the line. This now brings us to the more financial side of things, where ultimately your monthly payments, as well as that decision to pay off or not your mortgage early, is going to, from a mathematical standpoint, come down to two main things, being that interest rate that you have on your mortgage, and then also the entire value of your mortgage as it stands right now, which was impacted by the size as well as value of the home that you purchased. Most of you are probably well aware of this, but when you're borrowing funds from a bank to purchase a home, you're fronting the down payment, and then the bank covers the rest of the purchase price, which becomes your mortgage on that property. And so your monthly payments, though, are going to depend entirely on the terms of the loan, the length, as well as the type of mortgage you have, and then also, well, the interest rate. And simply put, the larger your mortgage balance, as well as the higher the interest rate you have, well, the larger those monthly payments are going to be, and the more interest you're going to pay per month over the entire amortization period of the loan. The most popular type of mortgage in Canada, though, is the 5-year fixed mortgage. So let's take a look at this chart right here, which shows us the average rate based on the year that we can see all the way back to the early 1970s. So we can see right now that since around the mid to late 80s, well, interest rates on mortgages, the fixed year mortgage at least, have steadily declined to a point where now we're seeing some of the lowest historic interest rates we have ever seen. And back in the 80s, 70s, and 80s, of course, it would make a lot more fiscal sense to prematurely pay off your mortgage as quickly as possible, because the interest on your mortgage payments are most likely around 80 or 90% of the entire monthly payment, where little equity is being built. But right now, considering how low the rates are, each monthly payment you make is most likely going to have a significant chunk of equity being paid down right out the gate on your first monthly payment. So to better understand this, let's look at a quick example comparing two homes at the exact same purchase price of $500,000 and the same down payment of 20%, with everything else being the same other than the interest on that loan. So in example number one, at a 2% interest rate, your monthly payment would be $1,778, of which $666 is interest and $1,028 is equity. While in contrast to this, your monthly payments at a 5% interest rate would be $2,421, of which $1,666 is interest and only $671 is equity. That is quite the difference, of course, and when looked at over the entire 25-year period, represents $108,000 on the 2% mortgage and $300,000 in interest paid on that 5% mortgage. Hopefully this example clearly illustrated for you the massive difference that only a couple percent can make on that ratio between interest versus equity on your monthly payments at the exact same purchase price, as well as the exact same down payment. Considering everything we just covered, paying off your mortgage early also has to do with opportunity cost of the funds you have to invest with in the first place, where if you're able to create a higher return on investment in the markets or with other investment classes, real estate, even a business, for example, probably doesn't make sense to pay off your home early if your interest rate is in the 1 to possibly even 3% range. This is because historically speaking, if you look at say the S&P 500 and investment in an ETF that tracks the S&P 500, which is extremely passive, over time, historically average returns range between 8 and 10% per year. And so you're therefore able to create a higher return on investment, investing that excess capital in even a passive index fund like this one over prematurely paying off your mortgage that has say a 1 or 2% rate right now. So for example, if you were able to lock in a 30-year fixed mortgage last year in the low 1% range, which I know quite a few people actually managed to accomplish in the US, that is, we kind of don't really have that here in Canada. But even still, if you're able to lock in a 5-year fixed mortgage in the low 1% range, it kind of fiscally doesn't make too much sense to make those premature payments other than some psychological factors that we'll be covering later. With that said, the population's pretty split on whether or not paying off a mortgage on a home early or not is beneficial, so that might ruffle some feathers. From an actual mathematical standpoint, with a return on invested capital from the interest you're paying, it makes more sense if you have a low interest rate to not pay it off early. However, do consider that making those payments is 100% tax-free, not income, but equity that you're putting towards your home, because on a home, the equity that you're building is tax-free as you're not taxed capital gains when comes time to sell. And in the United States, the deal is actually even sweeter, where in Canada, we can't actually even deduct the interest that we're paying on our mortgage loans for our primary residence. That's something that would be absolutely amazing to do. Unfortunately, the Canadian government does not allow this like in the United States, where your rental properties, this is something you can do in Canada as well, but on your primary residence, you can also deduct from your taxable income the interest that you're paying on your mortgage loan. That would be amazing. All right, now before we speak about some psychological factors that impact paying off your mortgage early, well, I want to quickly speak about one last financial element to consider. Quite a few people really look at this difference between purchasing a home, having a property, and or renting as a very black or white thing. But the way I see this is that for someone to generate, say, $500 to $1,500 of equity, but in this case, it would be appreciation and or dividend income in a stock market portfolio, it usually requires a much larger investment portfolio to relatively consistently make that type of return than it is to have your down payment on a home and then start building that $500 to $1,500 of equity each and every month. I hope that makes sense. All right, so the main advantage though above all else as to why you would look to pay off your home prematurely is really that peace of mind and financial freedom that inherently comes with paying off your home. Of course, even if you don't have a mortgage on your home, there are still recurring costs associated with maintaining your home, such as maintenance, insurance, taxes, as well as some other things here and there. But for the most part, the mortgage is that largest payment and the largest financial burden for most people. And as we did earlier on in the video, you can try and estimate your opportunity cost and your cost of borrowing, return on investment, etc. But ultimately, I can pretty much guarantee that no one who has a paid off house is saying that they regret having paid off their home and having that financial freedom that comes with it. Running a home is extremely expensive, and having that freedom of just knowing that your home base where you live is fully paid for, that can be extremely invaluable for a lot of people. With all that said, I really hope that you purchased a home that actually makes fiscal sense for you based on your financial situation and your month-to-month income, so that you're not feeling underwater every single month in the first place. And personally, have I paid off the entirety of my mortgage? No, I have not. I recently just signed a 5-year fixed mortgage last year at this point, and this is over a 25-year period. Whether or not I make accelerated payments in the future, that's yet to be seen, but right now, the rate is extremely low, and it just doesn't really make sense considering everything else I have going on with different properties and my other investments and businesses to make those payments prematurely. But absolutely, I recognize the value of having a fully paid off home, and over time, this is 100% something that I'd like to achieve, having a fully paid off home. All right, so that wraps up today's video covering some different elements to consider when thinking about paying off the entirety of your mortgage on your home. I really hope you enjoyed the video. If you did, make sure to smash the like button, and I would highly encourage you to check out all the other real estate focused videos as well as the real estate playlist that I have on my channel that has multiple different real estate topics from single family homes to multiplex investing. So if that interests you, make sure to check out those videos on the channel. I'd also recommend that you check out the links down below in the description where we have some resources I use and recommend, and you can get some free money for signing up to some of those accounts. So on that note, thanks a lot for watching today's video, and I will see you in the next one.